Question number 13. In April 2019, when Dyck Exponents offered 100 shares for sale in an IPO, half of the shares were sold by the company and the other half by the existing shareholders. So 100 shares offered in an IPO. So company is selling their 50 shares, and also the shareholders are selling their 50 shares, each of whom sold exactly half of their existing holdings. The offering price to the public was 50, and the underwriters received a spread of 7%. The issue was heavily oversubscribed, and on the first day of trading, the stock price rose to 160. So, requirement number one: what was the proceeds of the issue to the company and to the shareholders? So, the company issued 50 shares, each has a price of 50, right? But we have to pay some underwriter spread on it, so we will deduct this underwriter spread 0.07%. It will be same for both. So if we multiply these, then we will get 2325. So these will be proceeds from the issue. Let's check the part number 2. How much commission did the underwriters received? So underwriters received 7% commissions. So in total, to calculate the commission, we can see that in total 100 shares were offered to the public. Each share was priced 50, and the underwriter commission was 7%. So by solving these numbers, we can get the commission, which will be 350, half of which was paid by the shareholders and half by the company. So this is our part 2. Then we have part C. How much money was left on the table? So money left on the table is actually the money is actually the underpricing, or the money which company had left on the table for those investors who have bought the shares in an IPO. So if we see from the questions, we know that the company offered the share at 50 to the general public, and on the first day its price rose to 160. So the difference between these two is actually the money left on the table. So money left on the table will be 160 minus 50, and there are total 100 shares. So this will be money left on the table for 1 shares. If we want to calculate it for a total 100 shares, then we have to multiply it with 100. So in total it will be 11,000. Part D. So this was part C. Now let's calculate the part D. What was the cost of underpricing to the selling shareholders? So all the commissions and all the money left on the table is actually the cost of underpricing. So underpricing actually is like the real price of this stock was 160, on which it traded on the first day in the stock exchange. So market evaluated it at 160, but the company did not receive the 160. So what the company received is $50, and they paid uh, 7% commission on these $50. So the each share gave around 46.5. Okay, so what is underpricing? So underpricing will be 160 minus 46.5. So this will be $113.5 per share. If we want to calculate it for 50 shares, right? Because they are asking underpricing for the shareholders. So shareholders sold only 50 shares, then it will be 5,675. So this is the cost of underpricing to the shareholders, and the cost of underpricing to the company will be the same because company have sold the same number of shares and at the same price.